With last week's Dow performance, worse since October, seems like exactly the right time to do some technical analysis and find out what the charts are telling us. Joining us now for that, Katie Stockton, founder and managing partner at Fairlead Strategies. Katie, good morning. Good to see you.
Good morning. You too.
It's interesting. S&P 500, it's not even 3% off its high, but there's been a little bit of wear and tear, I guess, under the surface. Where do you think that leaves the market field position-wise? Are we already due for a bounce, even if we're not that far from the highs?
I actually think so. Just based on what we're seeing as of last Friday, the S&P 500 came down below its 50-day moving average. Believe it or not, that 50-day moving average has provided support since November. And by that, I mean you don't see it break on a consecutive closing basis. And we actually haven't seen a short-term oversold reading from the S&P 500 since that low in November was established. So it means that we have a market that doesn't necessarily need to get too oversold to keep going and forge higher. So based on that, and based on the fact that some measures of market breadth or participation, things that measure advancers and decliners, got pretty oversold on Friday. In fact, it was the most oversold since May 12th, and then before that since March 24th, both short-term lows for the S&P. I do think we'll see a rebound this week, and that should preserve this short-term support that's in play. And of course, the cyclical sectors, which have really seen this sort of rotational pullback, they're also showing some signs of short-term downside exhaustion. They are short-term oversold and at least seem due for a little stabilization.
Yeah, to that point, Katie, do you think that it represented a decisive break of that leadership from cyclical and value stocks, or is this going to just be, swapping back and forth the leadership baton between growth and value for here on out?
Well, it's really sort of a macro technical force that's underway, and certainly the 50-day moving averages are highly publicized as support. So it was concerning to see a lot of commodities break their 50-day moving averages, benchmarks like XLF representing the financials. These breakdowns are really very minor in nature, and you have to look at them within the context of the uptrends that preceded them. The cyclical sectors, those that are leveraged to the reflation trade, leveraged to higher commodity prices, had done very, very well for several months. So some kind of retracement is probably healthy. For things like copper, support is about 10% below still. So we could still see these areas somewhat out of favor, at least in relative terms. But indeed, as you reference, there is the possibility for the major indices to still forge higher, and I think they will do so for the fact that the mega caps have now kicked back in. We have the FANG plus M plus Tesla stocks now posting gains in a tape that's very weak otherwise. So that can help these major indices, to which they're very heavily exposed to these mega caps, forge higher. We've seen the S&P reach a new high. We've seen the triple Qs reach a new high. And there's nothing bearish about new highs.
Yeah, that's right. While we have you, Katie, can you handicap the crypto move this morning in terms of Bitcoin, where it is relative to levels it should have to hold?
Well, as Jim referenced, Tom DeMark is looking at some support levels that are in play. And we also have, based on his indicators, some new signs of short-term downside exhaustion. Really, as of today in Ether, we also have a signal in Bitcoin that suggests that this downdraft may be overdone. It doesn't mean you rush out and buy into weakness, because a lot of the cryptocurrencies are below support at current levels. However, it does suggest that in the coming days, if we see a little bit of a rebound, we probably have another opportunity to add exposure, at least with a short-term time horizon. And even with the declines that we've seen over the last couple of months, their long-term uptrends are still largely intact.
And just based on what you said about how things like commodities, having had those great runs and their pullbacks don't necessarily mean it's game over, does the same go for something like Treasury yields now?
So Treasury yields have obviously had weak intermediate-term momentum for some time. They're not without support. I think we're probably just going to see more sideways to lower action there, and certainly the implications are probably greatest for bank stocks, and otherwise the interpretation is really very mixed. We're all kind of left wondering what the impact is on the technology sector as a whole, but really let's just stay with what's working, and of course that's the mega cap, sort of the more defensive areas within technology. And then even on the high growth front, we are seeing solar stocks, break out. We're seeing some software stocks break out above short-term levels. So I want to stay with that trade.
Shepard Smith here. Thanks for watching CNBC on YouTube.